When we talk about trying to price out and value property in this market, I can't imagine that's easy.
No, it's a pretty tricky environment, but we're fortunate because we're 3 decades into solving sort of the emerging and difficult problems around the housing and the U.S. real estate market. So we think we're pretty well positioned to tackle it.
How do you sort of assess what real value is? I mean, you're buying single-family homes in different markets, and you know real estate, as they say, is really local. Right. So can you apply what you know about, say, I don't know, a California market to what you would do, I don't know, in Texas or Chicago or somewhere else?
Well, as you said, all real estate is local, but the key is, for over 30 years, we've been aggregating that local, really micro data. So we think of every piece of real estate, commercial or residential, in a unique way. And so we know everything about the asset from a descriptive perspective. And we know its transaction history, we know who owns it. And then we have a view to think about valuing that asset in a very consistent analytical framework. And this is where it's different from sort of thinking about how to price your own. We might think about where something similar sold recently, what we call comparative analysis. What we brought to the world maybe 20 years ago, 25 years ago, was think about that asset as another investment opportunity, sort of in a sea of opportunities, and think about what return attributes might it have, what risk drivers might it have, and how does that expected performance compare to sort of everything else you can invest in. And what's really cool is we built out the ability to go and affect that strategy, which was super complicated because, as you can imagine, in our single-family rental strategy, we're buying oftentimes, most of the time, one home at a time. So that requires one of our team members to be in the home and do that last mile piece that only really a human can do. But that person shows up powered with a lot of data and analytics.
How many homes do you have in your portfolio right now, roughly?
So we operate about 50,000 homes, just under 50,000 homes.
The state of the housing market right now, when you look at that portfolio, how much of a ballast is it going to be if we are headed towards an economic downturn?
Yeah, well, listen, forecasting from here is very difficult. In the U.S., we have a very tight labor market, makes forecasting inflation incredibly complicated. So luckily, we're not in the sort of next quarter, next year business, we're in the next 10-year business. So the next 10 years, we feel very, very strong about the demand for our assets. There's a really big gap in the housing market created by about a decade or so of underdeveloping real estate. And then after the global financial crisis, it became very difficult for consumers to get a mortgage. So we've sort of came in and filled that gap to allow families to live in the neighborhoods they want to live in, even if they're not really able to get a mortgage or maybe don't want to buy a home.
Of course, the rental market, at least in certain parts of this country, have gotten a little crazy too. And in fact, if you're unfortunately living in a place like New York or even certain parts of California, it might actually be more costly for you to rent than to buy, despite the high valuations. How do you sort of decide how to sort of pick what's going to be in your portfolio with that longer term view? The idea that what's popular now or what consumers need now is going to be what they need 10 years from now.
Right. Well, look, this is part of what the top of the house is supposed to be figuring out, and we have a lot of smart people working on this. Another thing I think we picked up earlier than most, so post GFC, we realized people are going to need another way to access that home product. There's a lot of demand coming out of multifamily because people need more space just because they're advancing in life and have families and the things that require a neighborhood and a school. But really what's happening today, we're seeing is an acceleration of trends that we're fortunate enough to have picked up, which is, if you think about it, we've all sort of watched shop from home, and now with the high-speed internet coming to the doorstep, to the doorknob, now we have great entertainment at home. Now we have high-speed communication at home. Airbnb allows you to vacation at home, and now we talk about working from home. So we like to point out to people is the last word in all of those at-homes is the home. Right. So really, the single-family residential real estate is picking up all the occupancy being created.
Right.
Lost by office and retail and dining and those types of things. So that's really that long trend.
How much exposure do you have to commercial real estate right now?
Very little. So we manage $25 billion in assets. We have $1 billion worth of first lien mortgages on transformed real estate, people that are sort of repositioning a piece of real estate. We love that business. Take an office building that maybe people don't want to go to work anymore and knock it down and turn it into something else. Someone has to balance sheet that project, so we love that business. Right. And we've seen stress in that business.
Like what? What's going on there?
We're really seeing stress. It's this work from home, and then the slow pace of stabilization. What does the new normal look like?
Right.
Is putting real pressure on property owners because their old method of attracting tenants, focusing on large tenants with long-term leases, just isn't working.
How viable, though, is that sort of transition? Because there's a lot of discussion that there's certain buildings, take an office building, that the way it's built, you can't really just easily retrofit it to make them apartments.
Oh, no, you can't.
The plumbing's not there. It's just a totally different animal.
Well, the local government has a big, big role in understanding how a building should be developed and how it's designed. And so those buildings are only designed to go from working there to living there. So the conversion to residential is very difficult. The conversion to lower dense uses, like data centers, is actually not that complicated. But what we'll see is most likely not a wholesale conversion from type to type, so from office to residential. And look, this early days, so this is not a forecast I would put a lot of capital behind today, but we think it's more likely that you see a switch from large tenants with long leases to smaller tenants with more flexible leases.
How does that affect, though, the future of big cities like in New York? Do you think that attrition that we've seen over the last few years because of the pandemic and everything else, that is kind of the new normal, or do you anticipate that maybe those big cities will kind of reclaim that past glory?
The way I think about it, and there's an adage in real estate, we say location, location, location. What I've tried to get people to think about now is this product. So when you see Manhattan, one of the greatest cities in the world, New York City, which we love, and you see it sort of in this down trough, it's upsetting. But I think what's happening is there's a lot of smart people in commercial real estate, there's a lot of smart people in local government, and they understand they're competing for residents in other places. So we're already starting to see the behavior change, both from real estate operators and from local governments, to kind of get back to clean, safe places to work, because there's nothing like the energy of a big gateway city. Now, we currently don't invest in the gateway cities of the United States. We're staying in where there's been obvious migration. To the sort of in the southeast, we think about it, so the Southeast Conference, Florida, Texas, and then the Carolinas. We have a little bit of investment in the West, Arizona. But those trends have been established for a long time. But we think the gateway cities, you shouldn't count them out because they will learn and they'll change.
Is it easier to find properties and investment opportunities in those areas that you were talking about as opposed to the gateway cities?
It is easier, and if you think about our where we sit, so we serve sort of the 1,000 largest investors in the world. They're allocating capital on a 10 to 15 year horizon. So what we're helping them think about is how do these cities morph and grow over time? And look, these gateway cities are in a transition period, so we're not exactly sure for our strategy they're investable today, but we're hopeful that they will be.
You are also involved in mortgage-backed securities, right? We are. You have a portfolio of that. Have we seen any stress there?
Massive. So I would say that I've been trading mortgage-backed securities for 35 years. And relative value in the long end of the fixed income market is as sort of great as it's ever been. The relative return you get for buying a mortgage-backed security to other high-grade fixed income is about as wide as it's ever been. So there's real stress already seen there. And that's really sort of a tricky thing because those assets absorb a lot of balance sheet. So when you're buying a Fannie Mae mortgage-backed security, even the one that's radically undervalued may only produce a return that's 100 to 150 basis points over the risk-free rate. So the capital that's moving today, and we're in this period of time to where we've had a lot of, what I would say, excess fiscal policy that's now being sort of offset by really aggressive monetary policy that's really shut down capital flows. And you can see it in these sort of balance sheet absorbing securities. And those are sort of the early indicators of a bigger problem.